Are you ready to take control of your financial future? Could your savings be earning a higher return? Introducing my ultimate guide to mastering cash alternatives and taking advantage of this current high interest rate environment. Today's banks are sending us all these advertisements. I actually got one in the mail the other day, teasing us with high interest rates, 4.75%, but if you read the fine print, it's such a short term. They only guarantee that rate for 6 months, and then after that, you're at the mercy of whatever the current interest rates are. Instead, picture this. You wisely invest a portion of your hard-earned cash reserves into some cash alternatives, where you continue to steadily outpace inflation, but also take advantage of these high interest rates for longer than 6 months, perhaps lock it in for a year or two, depending on how liquid you need the money is the rate or the proper vehicle. So in my comprehensive guide, you'll discover the power of several different cash alternatives, and I'll give you in the in-depth benefits of each option, weighing the pros and the cons. Whether you're a seasoned investor or just starting out, my guide is packed with professional advice, investment strategies, and practical tips to help you navigate the world of cash alternatives. Don't miss out on this opportunity to preserve your financial future. Get your copy of my free cash alternatives guides today. Click the link now to get your free cash guide and take the first step towards making your money work for you. I am an unapologetic equity investor. I truly believe the best way to build long-term wealth is by investing in great companies, i.e. buying stocks, and holding on to these companies for the long term, not being forced to sell because of an emergency or a shorter-term goal. So, with that being said, there's certainly a role for other types of investments inside of a portfolio, whether it be cash alternatives, bonds, whatnot. Before we get into the specific investments inside this guide, I want to talk about the role cash plays. First one's obvious. As you're accumulating towards your goals, you want to have a cash reserve. This is money for emergencies and opportunities, something you might want to buy in a year or two, whether it be a car, down payment on a home, or protect yourself against losing an income. So there's emergency and opportunities. It's not just when you need a new furnace. Rule of thumb is 3 to 6 months. Some people go out as much as a year if they're self-employed or have variable income. So that's the first rule. Second one is, if you have a shorter term investment, you don't want to risk the stock market being down and not being able to put the down payment on the house. So having a secondary cash reserve, or more of a non-retirement type of account, that there's less taxes and less penalties and it's more liquid. And if you have a goal that's 3 to 5 years away, you're going to want to make sure that that is not fluctuating in the market. You don't want to be risking not being able to have that dream vacation or have that down payment on something because the stock market happens to be down the year that you need to do it. And the third way people use cash in portfolios is implementing my 3-bucket strategy. And you'll get a link to this inside the guide. The 3-bucket strategy talks about the first bucket. You have 2 years of net expenses. So if your income is $80,000 and your expenses are $100,000, you need $20,000 from your investment portfolio. So I like to have 2 times that number inside bucket 1. So for 2 years, you can live off of something that's liquid and risk-free. Then the bucket 2 is more income-generating things that we use to replenish bucket 1. So some of the cash alternatives in this guide you'll read about, and that'll fit into bucket 2. And the third bucket is for your long-term equity holdings. So as inflation and lifestyle goes up in retirement, you're going to take bucket 3 to replenish bucket 1 and 2 throughout the way. So for each asset in this guide, I ranked it from 5 different criteria, from low to medium to high. First criteria I looked at was liquidity. When can you actually spend the money? Is it locked up? Will it be available when you need it? Next one is stability. Are there guaranteed returns? Will it lose value? Predictability. How much will it be worth 1, 2, or several years into the future? Is this a known amount, or does that rate adjust? Yield. Now this can come in the form of interest, dividends, coupons, and whatnot. But basically, how much income can you generate from this type of vehicle? And the last one is inflation protection. Will higher inflation and rates boost its return? If we're not out of the woods on inflation, we have to keep that in mind as well. Before we get into the cash alternatives, let's take a look at cash itself and run this exercise for that. Everyone should have some cash on hand. And the pros of cash are the cash won't lose value. Also, if it's in a bank, it's backed by Uncle Sam. And if under the FDIC limits, it's insured. There's a tool in the guide called the EDIE tool. There's a link to it. So if you want to see how much cash of your cash is insured, follow that link. Now, the cons of cash are, historically, cash returns approximately 3% less than bonds over the long term. And there's a chart in the guide that shows you all the different returns of the different asset classes. Current rates are well below inflation rates, so your cash is actually losing money, purchasing power, versus inflation. In some forms of cash, while it can be spent immediately, there's others, such as CDs or money market or high yield savings, that may limit the amount of transactions or may charge you a penalty if you don't hold it to full term. Now, as far as the criteria go, cash liquidity is high, stability is high, predictability is high, yield is low, and inflation protection is low. First cash alternative I'd like to explore is through the US Treasury. And these can be summed up by safety and attractive yields. So when Uncle Sam borrows a lot of money, he's doing this by issuing treasuries. And there's 3 types of treasuries that can be issued. Treasury bills are for maturities from weeks up to a year. Treasury notes from 2 years to 10 years. Treasury bonds, maturities over 10 years, often up to 30 years. Normally, the longer the maturity, the higher the yield. In the current rate environment we're in, you're actually getting paid more to take the short term because right now the rates where they don't want to be locking up those rates for 10, 30 years. Some of the pros of US Treasuries are that they're the safest investments available, highest rated bonds available. Interest rates are fairly taxable but free of state income tax. And the cons of Treasuries, the value of Treasuries will fluctuate when changes in the interest rates. And it can also take up to 2 days to turn Treasury into cash you can spend. I have, for the 5 criteria, Treasuries rated as medium liquidity, low stability, high predictability, medium yield, and low inflation protection. Next asset I'd like to take a look at as a cash alternative is I-bonds. These can be summarized as stability and inflation protection. The interest rates on I-bonds has 2 components. The first one is fixed at the time of purchase, and the other one adjusts every 6 months. The adjustment is based on what the CPI, Consumer Price Index, has done. The pros of I-bonds is they don't drop in value, even during times of deflation or raising rates. The rate adjusts to keep up with inflation and maintain purchasing power. However, the rate can also go down. Interest rate is federally taxable, but free of state income taxes. Bondholders can choose to defer taxes until the I-bond is redeemed. I-bonds are free of all taxes if proceeds are used to pay for qualified higher education expenses, subject to household income limits and other adjustments annually. The cons of I-bonds, they can't be redeemed for 1 year, so they're not liquid. If redeemed between years 1 and 5, the bondholder will pay a penalty equal to 3 months' worth of interest. I-bonds can be purchased in denominations as small as $25 and no more than $10,000 in 1 year per person, with an additional $5,000 per person with a federal tax refund. A negative is they can only be purchased directly at the original auction via the treasurydirect.gov website or with a refund of a tax return. So when you look at the 5 criteria for I-bonds, we have liquidity is low, stability is high, predictability is medium, yield is high, inflation protection is high. Money market funds are a great cash alternative, and they're also a very good option for inside of your investment account for money that you need liquid and safe. Some of the pros of money markets are retail money market funds strive to maintain a net asset value, share price, of $1, so the investment is very likely to maintain its value. The yields on competitive money market funds right now are higher than banks. I've actually seen some over 5% recently. Cons of money market funds are, while very rare, there have been instances the funds drop below that $1 a share. In 2007-9, during the Great Recession, there were 78 money market funds that were considered at risk of breaking the $1 barrier, but only one of them actually did. So depending on the fund It can take also up to 1 or more days to turn that into cash you can actually spend. So when I take a look at money market funds, using the 5 criteria that we've been using for the other asset classes: liquidity, medium; stability, high; predictability, high; yield, medium; inflation protection, low. Another cash alternative is Treasury inflation protected securities, or called TIPS. These are safe but quirky type of investment. TIPS, they pay interest rate that is fixed, but the principal adjusts upward or downward every 6 months according to increases or decreases in the CPI, Consumer Price Index. So maturity, you'll get back the original principal price or the adjusted principal value, whichever is greater. And interest is paid every 6 months on the adjusted principal amount. So these can be bought in multiples of $100 and maturities of 5, 10, or 30 years. Though different maturities are available on the secondary market. So the pros of TIPS: like all treasuries, TIPS are backed by the full faith and credit of the US government, and consequently are considered among the safest investments in the world. TIPS provide an inflation hedge since the principal adjusts every 6 months according to the CPI. They also provide a deflation hedge since they are guaranteed to be worth at least the initial value when they mature. And TIPS are subject to federal taxes but are state income tax free. Some of the cons of TIPS is they fluctuate in value as rates move up and down. As they grow, in any year that the principal increases, taxes are due on the increase. You can combat this by putting them in an IRA. So let's look at the 5 criteria for TIPS. Number 1, liquidity is medium, stability is low, predictability is high, yield is medium, and inflation protection is low. Next up to be analyzed are corporate bonds. So these have extra yield and extra risk, making them more appropriate for bucket 2 in the 3-bucket strategy we talked about. So when a corporation wants to raise some money, it has 2 choices. Number 1, offer stock, essentially sell part of its business. Or 2, issue bonds, borrow money from investors. Because there's a risk that the corporation could go out of business, corporate bonds offer higher yields than cash or treasuries to entice the investors. Corporate bonds are evaluated by rating agencies such as Fitch, Standard & Poor's, Moody's. The lower the rating, the more risk, the higher the yield. The overall bond market is split into 2 broad categories: investment grade and speculative grade, or so-called junk bonds. So part of the guide, I break down the different ratings and whatnot. But for this purpose, let's just take a look at investment grade. They have a default risk, meaning the company goes out of business and they don't pay their bonds, of 0.86%, so less than 1%. Speculative or junk bonds, high yield bonds, is 18.91%. So when an issuer defaults, bondholders, they might not lose everything. They typically recover maybe 25 to 50%, but it could take quite a while. So the pros of corporate bonds: they offer a potentially higher return than cash or treasuries. Cons of corporate bonds include price of corporate bonds will move up and down according to changes in interest rates. So imagine a few years ago you had a bond that was paying 2%. Interest rates are way up. That bond is less attractive. So a new bond that might be paying 5 or 6% is what investors are going to flock to it. So you may not be able to resell your initial bond for what you paid for it. The price fluctuates. There's also a risk that the issuer won't be able to pay interest or return the principal. And most longer maturity bonds are callable, which means the issuer has a right to cancel future payments and refund your money. So if interest rates go way down and they'd want to get that bond that's paying high rate off their books, they have the right to do it. So you have to make sure you read about those. Let's take a look at municipal bonds. These have reasonable safety with some tax benefits. So investors in a higher tax bracket, they might want to consider some of the benefits of receiving federal and perhaps state income tax-free yield. The government entities, they do go bankrupt. Think of Detroit in 2013. Default rates are actually much lower than corporate bonds. So for investment grade, for the past 50 years, between 1970 and 2020, investment grades have only defaulted 0.04% of the time. And according to Moody's, that figure only goes up to 4.79% for more speculative grade municipals. So the key to deciding whether municipals make sense for you is calculating the after-tax equivalent yield. And there's a calculator in the guide that you can use. You can put a corporate bond versus a municipal bond, put your tax rates in, and see which one is more profitable to own. So the pros of municipal bonds are they have a lower default rate than a corporate bond. And interest rates are generally free of federal taxes and can also be free of state taxes and local taxes if you buy them from the municipality you reside in. So the cons of municipal bonds, so not all municipal bonds are free from all taxes. So make sure you understand the tax status of any bonds you buy. And the price of municipal bonds will move up and down according to changes in interest rates. So the financial performance of the issuer and the state of the overall economy are a factor when you're choosing these. Many municipal bonds are callable, so which means the issuer has the right to cancel future payments and refund your money at different call dates. So let's look at the 5 criteria and rank them. So for municipal bonds, liquidity is medium, stability is low, predictability is high, yield is high, and inflation protection is low. Next up are fixed annuities. Safe and steady returns in exchange for liquidity. So fixed annuities are offered by insurance companies that guarantee returns and can provide you with income for the rest of your life. They are particularly appropriate for conservative investors who want income without stock market risk. But understand the trade-off. Your money will be tied up with a contract and inaccessible if you need it before the end of the term. Some contracts allow you to take out 10% of the principal or interest during the surrender charge period. While the surrender charge historically has been one of the biggest negatives about fixed annuities, I'm finding a lot of people the past year are not minding locking their money up for 3, 5, 7, 10 years because they're nervous that their 1-year CD or 2-year CDs, when they mature, are going to be maturing and then being reinvested at a lower rate. So while we're seeing rates for the medium term over 5%, people are nervous that if our economy goes into a recession, that their interest rates will decrease back to what they've been used to over the past 10 years. The pros of annuities, there are guaranteed returns no matter what's happening in the stock market or bond market, interest rate hikes and whatnot. So you're guaranteed principal and guaranteed interest, and it's a known quantity. Many offer an income for life benefit or for a specific term. So if you want to, you can take these rates and lock them in for the rest of your life and get a guaranteed income stream that will never disappear. And they're only taxed at withdrawal, so they're tax deferred. So if you're accumulating money in this vehicle, you're not going to pay taxes each year like you would on a CD or a bond. So the cons of annuities, there are surrender charges. So if you need to withdraw money before the end of the term, you may pay to get your money back out. And you have to shop around for a good rate, as annuities vary widely by company. And their tax treatment can also be complex. Now to get these rates, there's different rules you have to follow where you might have to wait till after age 59 and a half. So they lack liquidity, especially for younger investors. When I take a look at the 5 criteria we've been evaluating for fixed annuities, the liquidity is low, stability is high, predictability is high, yield is medium, and inflation protection is medium. What's the best way to buy your bonds? Individual bonds versus bond funds and ETFs. So many of the investments we've discussed, namely treasuries, TIPS, corporates, munis, can be bought individually or via mutual funds or ETFs. Each choice has its charms, so let's discuss the pros and cons. So the pros of buying an individual bond. By buying individual bonds, you know exactly how much interest you'll receive and how much you'll get back when the bond matures. Regardless of what happens to the economy, the bond market or interest rates, assuming, of course, the bond issuer is still in business. The cons are buying an individual bond takes more work and education. Investors need to learn the terms as well as how bonds are priced, traded, and taxed. Investors should own many bonds for proper diversification. This can take between $50,000 and $100,000 to buy enough bonds to be properly diversified. And most bonds are issued by denominations of $1,000. Though the range can be from $100 to $5,000, the higher denominations make it difficult to easily reinvest payments in new bonds, and there may be costs involved. Let's look at the pros of bond mutual funds and ETFs. ETFs are generally more tax efficient than mutual funds because they are structured differently. They're designed to track an index of stocks or bonds rather than actively managed fund or fund manager. This means they typically have lower turnover, which can result in fewer capital gains for investors. Bonds provide instant diversification, and they typically have hundreds of thousands of holdings. So if one issue goes under, investors shouldn't see a significant loss. Distributions from a bond fund can be automatically reinvested to buy more shares of the fund at no additional cost. So the cons of bond funds and ETFs? Because bond mutual funds are made up of so many parts, hundreds of holdings with different maturities constantly being bought and sold, investors can never be sure exactly how much the investment will be worth or how much income they'll receive. This is a particular concern for investors who are counting on their bond investments to return a specific amount of money in a specific date, such as retirees investing in bonds for income. Funds charge ongoing expenses. Fortunately, many super low-cost options are available nowadays. While ETFs may be more tax-efficient overall, some specialized and leveraged ETFs can generate high levels of short-term capital gains due to frequent trading. These gains can be taxed at higher rates compared to long-term capital gains. And additionally, investors who trade frequently within their ETF holdings may trigger short-term gains on their profits made. And because bond mutual funds are actively managed by fund managers, they tend to have higher turnover rates than ETFs. And this may generate more capital gains distributions, which can be subject to tax. So for bond funds, liquidity is medium, stability is low, predictability is low, yield is medium, and inflation protection is low. Another way to invest in bonds is by using target date funds, kind of the best of both worlds. If you're looking to buy bonds for income and diversification, yet you're concerned about the risk that rising rates could pose to traditional bond funds, consider a relatively new type of fund, a target date bond fund, also known as defined maturity bond fund. It holds a diversified portfolio of bonds that mature in the same year. So by the end of that year, the ETF or bond fund will be 100% cash, which will be distributed to shareholders. So a defined maturity bond fund are for people who are not inclined to buy individual bonds because of the investment risk, want the diversification, but also want to be able to know that their bonds are going to mature, if they don't default, at par. So you have more control over people buying and selling a fund and you being subjected to their capital gains or capital losses. So the pros of target date bond funds is there's reduced interest rate risk. The defined maturity bond funds offer exposure to a diversified portfolio of bonds that all mature around the same time. This can help reduce interest rate risk since the fund will hold bonds until they mature rather than selling them on the open market. Predictable income streams. Because defined maturity bond funds hold bonds until maturity, you know what's inside of it and you know what you're going to be getting paid. Investors can generally expect to receive predictable income streams over the life of the fund. And diversification. You're holding a mixed bag with different maturities and credit ratings. Defined maturity bond funds can provide investors with exposure to a range of fixed income securities. With the pros, there are a few cons. There is interest rate sensitivity near maturity. As the defined maturity bond fund approaches its maturity date, it may become more sensitive to changes in interest rates, which could impact its value and returns. There's also credit risk, and there's also liquidity risk. If investors want to sell their shares of a defined maturity bond fund before its maturity date, they may face liquidity risk. If there's not enough demand for those shares in the secondary market, this could result in higher transaction costs or even difficulty selling their shares altogether. So applying the same 5 criteria to target date bond funds, liquidity is medium, stability is low, predictability is medium, yield is medium, and inflation protection is low. So let's pull all this together and start by looking at what types of investments would fit what types of goals. So first thing is we look at is emergency fund. Remember we talked about that being between 3 and 6 months worth of your expenses. This would be pure cash, high yield checking or savings accounts, money market accounts. Next is money you need within 1 to 2 years. Here we're talking about, again, high yield savings accounts, money market accounts or funds, CDs, and perhaps even looking at treasury bills. Next up is money that you need in 2 to 3 years. This would be a CD ladder or treasury ladder. 3 to 5 year time frame, now we're talking about short or intermediate term bond funds, target date bond funds with a longer maturity. And then once you start getting into 5 or more years, opens up the world of fixed annuities, total bond market or intermediate term bond funds, target date bond funds and ETFs, I bonds, and TIPS. So you've heard it all before, but we'll say it again. The amount you invest in stocks, bonds, and cash depends on your risk tolerance and investment time frame. Getting the right mix of risky assets, stocks, and safety assets, bonds and cash, is one of the most important decisions an investor can make. So make that with a good sense of how your situation and preferences will affect this balance in your portfolio. I've developed the Thrive method. It can help investors understand the different ways a portfolio can be constructed and how might be allocated to cash, bonds, and stocks. So you can explore my model portfolios for different risk tolerances by following a link in the guide. And while every situation is unique, structuring your cash and bond holdings based on when you need those is what's the most important aspect when it comes to these types of decisions. So I want to thank you yet again for your attention today. If you made it through the end of this thing, I really do appreciate your support. And I know there's a lot of competition for your eyes and your time. So the fact that you spent this much time with me today, I truly appreciate that. And if there's anything I can do to help you answer some questions, never hesitate to reach out. And if you want to get these updates, make sure you follow me on social and also subscribe to my YouTube channel. I appreciate that as well. Thank you and have a wonderful day.